Who sets monetary policy in the United States? Let's imagine a vast economy like a ship trying to navigate stormy seas. What authority is in charge of steering that ship, navigating inflation, employment, and the flow of money? Who's in charge? Is it the president? Is it Congress? Or perhaps a more independent body that's been designed to avoid short-term political pressures? Helen-Ann here, and thanks for joining the Jersey Shore Real Estate Experts and eXp Realty and Living at the Jersey Shore. Welcome to our YouTube channel. Thank you all for joining us today. We're going to spend a little bit of time demystifying monetary policy in the United States, interest rates, and mortgage rates. Stay tuned. Make sure that you listen, like, follow, click all those fancy buttons below. It's really important that you follow us. And more importantly, I'd love to hear some of your comments. I think discourse is fantastic and your opinion certainly matters to us. Today, I want to talk about trying to demystify a little bit regarding interest rates, the prime interest rate, mortgage rates, and monetary policy here in the United States. What I have come to find in the past number of weeks, hosting a lot of open houses, meeting a lot of wonderful people, and also speaking to some of my own clients, there seems to be a little bit of confusion as to who sets mortgage rates here in America. And I want to try to demystify that a little bit, talk about that, and clear some things up. And I think the best way for us to do that is to have a little history lesson. Let's go back a few years. Who is the Federal Reserve Bank? What is the Federal Reserve Bank? And essentially, what do they do? The Federal Reserve Bank was created and is essentially the U.S. Central Bank of the United States of America. It was created by the Federal Reserve Banking Act in 1913. The Federal Reserve was essentially created by Congress. The idea behind it was to establish a monetary system that could respond effectively to the stresses in the banking system. The Federal Reserve Bank, also known as the Fed, not the feds like as in Uncle Sam, but the Fed or the Federal Reserve, is an agency. And essentially, this agency, it consists of a central bank that is located in Washington, D.C., and then there are 12 regional banks located around the country. And for the most part, doing some research for this, I've come to find that many of the regional banks are located more along the northeastern part of the United States, not a lot of representation out west, for whatever that's worth. This essentially was a system that was built for stability, to provide stability to the banking systems. I'm going to be a little tongue-in-cheek here just for a second and follow me. Because again, it was made for stability, supposed to be independent of political pressures, correct? However, when you think about this, the Federal Reserve Bank intended to be an independent body designed to avoid short-term political pressures. Yet, it's a federal agency created by Congress, with a central bank located in Washington, D.C. So let that just sink in for a little. I have some concerns about the Federal Reserve and the central bank and how they actually do benefit us here in America. The central bank is really supposed to be a lender of last resorts to the local banks and to really kind of help keep these local banks from getting themselves into trouble, designed to provide stability and to respond effectively to the stresses. In doing a lot of research for this particular topic, I've come to find that within the community of economists, there seems to be a very large study that was done, and it seems as though there's some economic data that has been looked back upon, some research that has been done, and there seems to be a pretty large growing thought that the Great Depression may have been caused by the Federal Reserve back in the 1920s. The Federal Reserve Bank was created in 1913 to create stability, and I believe from what I was reading in a lot of their monetary policy that was not good monetary policy because they were new at this game. They actually caused some problems. Also, of course, U.S. banks were freaking out and Americans were walking into U.S. banks and saying, hey, give me my money. And the dilemma was the money was not there. At the same time, internationally, Germany was experiencing a massive debt crisis. And our friends in France were hanging onto their gold and they weren't willing to give it up. So needless to say, we really had quite an economic crisis that happened here in America and lasted for many, many years. And a lot of people in the world of economics believe that it was our Federal Reserve Bank that may have caused this crisis inadvertently. So what does the Federal Reserve Bank actually do? What they do is they set something called the federal fund rate. That's the prime interest rate. The federal fund rate is the short-term rate that banks use to lend money to each other. This is not the mortgage rate. This is called the federal fund rate or the prime interest rate. That is set by the Federal Reserve Committee. This is a committee of 12 individuals. They tend to meet approximately at least 8 times a year. So again, mortgage rates are not set by the Federal Reserve Bank. The Federal Reserve Bank, or the Fed, and this committee of 12 that meets approximately at least 8 times a year, they are the one that determine the prime interest rates, and that's the short-term rate that banks are lending money to each other. Key here is the short-term rate. Okay. Based upon economic data that's been floating around, the Federal Reserve Bank was meeting on Tuesday the 16th and Wednesday, September 17th, today if you're watching today, and they are going to be making some determinations on some of their new policies or some policy changes. And any determinations or policy decisions that they're going to be making are usually posted after 2 o'clock on day 2 of their meetings. So later today, we're going to be hearing about some of the new policies that the Federal Reserve may be making, and they are talking about maybe easing a few basis points off of that federal fund rate or that prime interest rate. Essentially, they meet to create monetary policy. They look at the economy and all sorts of things, and then from there, they decide what that short-term rate of money should be. So we're clear that the Federal Reserve Bank set the short-term rate for money. That's that federal fund rate or the prime interest rate. So where do mortgage interest rates come from? Mortgage interest rates tend to be tied to more longer-term economic and financing instruments, more like the 10-year Treasury yield bond, because it has a 10-year note. Obviously, it's a 10-year note, the 10-year Treasury yield. Mortgage rates tend to be tied to longer-term financial interests, not the short-term prime rate. But keep in mind, mortgage interest rates are a lot more volatile because they're not established by a federal committee. Mortgage interest rates really more flow with the market. They flow with the temperaments of the banks. They tend to flow more with the temperament of the financial markets. And a lot of times, if the financial markets are feeling warm and fuzzy about what they believe the Federal Reserve Committee is about to do when they meet, meaning if the financial markets believe that the Federal Reserve is going to potentially lower their basis points and lower their prime rate, they will often preemptively have flows in interest rates, and mortgage rates will actually come down. And quite frankly, mortgage interest rates came down last week in advance of the Federal Reserve Bank meeting on September 16th and 17th. Hasn't happened yet, but the Federal Reserve Bank is in anticipation of what their meeting is. The financial markets were already saying, hey, we think they're gonna cut that prime rate. Let's shave a little off from interest rates. Shave a little bit off of the mortgage interest rates. And last week, mortgage interest rates have come down. They're below a point where they were up until October of 2024. Quite frankly, they're at the lowest point that they've been in the past 12 months. So when I was speaking to a meeting with people, they were like, oh, we want to wait to see what the Fed does, and see what happens with mortgage rates. And I'm thinking, but the Fed doesn't make mortgage rates. And the financial markets have already predicted that the Feds are going to reduce interest rates, prime interest rates, or the federal fund rate. And they, in turn, have shifted and brought the mortgage interest rates down. They don't necessarily move together. There tends to be an ebb and a flow. And the banks that are determining what their long-term rate of lending money is going to be, a lot of factors come into play. Not just the federal fund rate, but the banks also take into consideration other lending competition, the credit worthiness of a borrower, temperament of the economy. So there are a lot of things that go into what's happening with mortgage rates or what makes a mortgage rate. But it's not the Feds, just so that we're clear on that. And again, if banks aren't feeling warm and fuzzy about the economy, they don't care what the Fed's going to do. If they're not having a positive outlook, they're not going to adjust mortgage interest rates. They may actually raise them if they're not feeling good about things. So that's kind of how that happens there. It's not necessarily a direct correlation between one and the other. It doesn't always happen that way. And just keeping in mind, mortgage rates actually came down last week. Will there be more mortgage rate reductions as we get into the end of 2025 and into 2026? It's predicted that that will be the case because it's predicted that the federal fund rate may come down again at least 1 or 2 more times before the end of the year. Interest rates right now have been at the lowest level since October of 2024. What I'd like to say to you is please don't wait for mortgage interest rates or the feds to make any kind of decisions for you to decide what's best for you and your family. People buy and sell homes every single day for all sorts of reasons. We sell second homes, we sell short properties, we sell investment properties. Don't let the interest rate be your reason for not making that move into your next chapter. Don't let interest rates be your reason for not taking that next step, not trading up, not creating the memories for your family. Don't put your life on hold or your dream on hold for interest rates. I think the best thing for you to do is consult with a mortgage professional, consult with a real estate professional like ourselves. We're here to help you. We're here to guide you and advise you. There are a lot of mortgage products available today that can help make it be affordable for you to get into that next home. I think it's important to strategize, but not to put your life on hold for an interest rate. If you're waiting for rates to come down, I'm not sure what you're waiting for them to come down to. Happy to have a spirited discussion, an educational discussion to kind of help you understand what's happening so that you can make the best decisions for yourself and for your family. We thank you for following the Jersey Shore Real Estate Experts. Thank you for tuning in. Any questions, fire again. I'd like your comments, like your discourse. Your opinion matters to me, and I'd like to hear from you. Thanks again, and have a great day.